Let's go ahead and go through the solution to question number 5 in the Module 7 additional problem. So in this case we have an upstream sale of equipment. Little sold equipment to Big for $24,000. The equipment had been purchased by Little for $100,000 6 years earlier and was being depreciated straight line over a 10-year expected useful life with no expected salvage value. Both Big and Little used separate accumulated depreciation accounts. The expected total life and salvage value were unchanged, and then on 4/1/20 the equipment was sold to a third party for $23,000. So we have a couple things going on here. First, we have to go ahead and compute how much of a gain or loss there was on the intercompany sale. The equipment had a cost of $10,000. It had been depreciated for 6 years at $10,000 per year, so it had a book value of $40,000. It was sold for $24,000, a loss of $16,000. That $16,000 loss is going to be recognized over the remaining 4 years of the asset's useful life by adjusting depreciation expense. And in this case, since we're trying to recognize a loss, we're going to be adjusting depreciation expense upwards by $4,000 per year. So first, in 2018, our first elimination entry, we're going to go ahead and debit equipment for $76,000. Again, that equipment is on Big's books for $24,000. The correct historical cost is $100,000, so we need to write it up from 24 to 100, an increase of $76,000. We need to go ahead and reinstate the $60,000 of accumulated depreciation that was eliminated at the time of the intercompany sale, and we're going to go ahead and eliminate that $16,000 loss that Little is reporting on their income statement. So we've essentially, with this entry, undone the original sale, and now we need to go ahead and recognize a portion of that loss. And again, we recognize a portion of the loss by adjusting depreciation expense upwards by $4,000. The income to the non-controlling interest, the non-controlling shareholders will get 40%, their share, of the reported earnings plus or minus the various income adjustments. And again, this was an upstream sale, so this transaction does affect the income to the non-controlling interest. Looking at our two elimination entries, we have a $16,000 credit to an income statement account that's going to increase income, and we have a $4,000 debit to an income statement account that will decrease income. So the non-controlling shareholders will get 40% of $100,000 plus $16,000 minus $4,000, or $44,800. In 2019, again, just to summarize, we have a 60% owned subsidiary. The parent uses the partial equity method. We had an upstream sale on January 1st, 18 with a $16,000 loss being recognized over 4 years. So in 2019, again, our elimination entry, we still have to write the equipment up from its current cost of $24,000 to its true, correct historical cost of $100,000. Accumulated depreciation, think of what we did last year in 2018. Last year we credited accumulated depreciation for $60,000, and then we credited it for another $4,000, so we're carrying forward a $64,000 credit to accumulated depreciation. Now this doesn't balance, we're missing $12,000. The $12,000 we're missing is the remaining, as of the beginning of the year, the remaining unrealized loss that we're carrying forward. Since this was an upstream transaction, we're going to take that $12,000 and split it 60-40 between the parent and the non-controlling interest. And since the parent is using the partial equity method, we're going to go ahead and credit retained earnings for their share of that $12,000. We would do the exact same thing if the parent were using the cost or original value method. The relevant point here is that the parent did not adjust their investment income, they did not adjust their income to remove the unrealized gain or loss, which means their retained earnings account has an incorrect balance. In any event, once we do that, we're sort of reinstating where we left off at the end of 2018, and now we go ahead and take another year's worth of adjustment to depreciation expense. The income to the non-controlling interest, the non-controlling shareholders will get their share, 40%, of the reported earnings of $100,000 minus that $4,000 debit to depreciation expense. Finally, we move forward to 2020. Again, we're going to first start up by sort of reinstating or picking up where we left off at the end of 2019. We carry forward that $76,000 debit to the equipment account. We're now carrying forward $68,000 in credits to accumulated depreciation. The missing $8,000 is the remaining unrealized loss on sale of this asset. And again, that $8,000 is going to be split 60-40 between the parent and the non-controlling interest. Now in 2020, this equipment is going to be sold to a third party. So that $8,000 unrealized loss is going to be realized. Now a portion of that we're going to realize by adjusting depreciation expense. And again, we're selling this asset on April 1st, 2020, so we're going to go ahead and prorate 1 year's adjustment. It was $4,000 per year, so for 3 months we're going to take $1,000 of additional depreciation expense. The other $7,000 is simply going to be recognized as the loss on the sale of that asset. Now again, think of how we're carrying things forward here. The equipment account, we started by debiting it for $76,000, so in our elimination entries we've created the $76,000 debit that doesn't exist on Big or Little's individual books. We have to get rid of that. Same thing with the accumulated depreciation. We credited accumulated depreciation for $68,000. We credited it for another $1,000. So in our worksheet entries, we have a net credit of $69,000 to accumulated depreciation. This asset no longer exists, or it no longer exists on our books. So we have to get rid of that $69,000 of accumulated depreciation. The income to the non-controlling interest, again, same thing as before. We start with 40% of the reported earnings, and we look at these elimination entries and ask ourselves, how did they affect the income from the subsidiary? We have a $1,000 debit to the income statement, and then a $7,000 debit to the income statement, both of which reduce earnings. Now, just to sort of confirm that $7,000 debit to loss on sale might throw you for a loop. Just to sort of confirm what we're doing here. This was an upstream sale, so this asset was on Big's books. Now, Big, on the date of sale, is reporting a book value. They've got a cost of $24,000. Big has been depreciating that over 4 years at $6,000 per year. So they've taken 1 full year of depreciation, another full year of depreciation, and a quarter year of depreciation. So Big's accumulated depreciation is $13,500. So Big's book value of this asset is $10,500. They sold it for $23,000, a gain of $12,500. So that's what Big is reporting on their income statement. The true book value, again, the true cost of this thing is $100,000. It's been depreciated at $10,000 per year for 8.25 years now. This is 8.25 years after the initial acquisition. So the true book value is $17,500. It was sold for $23,000, a gain of $5,500. So Big is overstating the gain by $7,000. The true gain is $5,500. It's being reported at $12,500. They're overstating it by $7,000. And so that's essentially what we're correcting by debiting loss on sale for $7,000. I guess it'd be better to go ahead and debit gain on sale. So we're more explicitly reducing the gain from $12,500 down to $5,500. But since we were initially recognizing a previously unrealized loss, I elected to go with debiting loss on sale. But essentially, we're cutting that gain down to size from the inflated value of $12,500 to the correct value of $5,500.